Matron, take them away.
Okay guys, hope you're well. Well, with this coffee with Scruff, we're going to have a chat about the different types of account and different types of trader you are. So let me get a slurp of coffee, because we all know Scruffy likes it coffee. And we'll begin. Now last week, I did a video for the 5%ers and I got one of the key guys, Alex, on to discuss the situation in America, because if you're unaware, the regulatories are looking at the prop industry and they've shut a few down. 5%ers took the decision not to onboard any more US clients, although they can still trade if you've got in, but they're not taking on any more because of the regulations. I then had a chat with one from Darwin X, because I reached out to a number of companies just to see if they would speak to me. And one gave his perspective of what's going on. And then you lot got involved in the comments. And some were very good, some were quite informed, and there was a lot that were uninformed. And what I kind of wanted to discuss, and see if you lot will discuss it below in the comments, and then I'll expand it in another video, is the different types of account, but the different types of trader. First of all, you've got three main types of trader. Well, you've actually got four. But the three main are your day trader, somebody that will be in and out of the markets within a single day, and they'll look for minimum targets. So 10, 20 pips, and they might do it 2 or 3 times a day. Come close a business, close, finish. So that's a day trader. Now, I'm going to discount scalping, because I don't think scalping, well, no, I won't, because it'll come into the fourth one. The next one is swing trading, where you're holding your position overnight and you're letting it run for a few days to a few weeks, and you're expecting a bigger return. Okay, go with that. And then you have a position trader that is putting a position on in January and they're looking to shut it out in December. Now the fourth one, and I'm going to roll scalpers into this, is a gambler. Scalping very rarely survives on the long term. Now, straight away, you'll have the boom and bust guys saying, oh, I'm a scalper, I do this and I do that. The question is, are you making a living from it, and have you done it for more than 5 years? Because if you've done it for a couple of months or a year, you might be one of the lucky ones, but sustainability and every report, and I mean every report, shows it's not sustainable. I can't do it. I truly can't. I sit somewhere in the middle between a day trader and a swing trader. But I trade small to the size of the account. I get in, I get out, and I'm done. And that was shown because they showed my records in those videos. Right. So if they're the traders, what's the difference between accounts? Because obviously you've got your own account, which is live fund. You put £1,000 into that. You have the responsibility of an entire £1,000. That is the liquid money that you have. Now you can put that into, say, a black bull, and that will give you 500 to 1 leverage, increasing the buying power of that amount. Now this is where a lot of people get stuck and blow accounts. Leverage is the death of accounts. Now again, you'll have the boom and bust saying, no, you can put it in. You over leverage an account, that means your position size is too big. And if your position size is too big relative to your liquid money, it doesn't take long to blow your account. So the advice is always size to the amount of money you have, and you use the leverage to open up a position. Now what that means is, if you want to open up the DAX and the FTSE, you need the buying power to be able to do it. FTSE is relatively cheap, but the DAX is really expensive. So you need that buying power. So that's the way to use the leverage side of it. Now, if you think about this, and we're going to stay on the leverage principle, you then move into the prop industry. And again, where people fail is you can buy into the prop industry. So we'll take 5% as an example. Can't remember off the top of my head what the fee for a 10,000 fund is. I think it's 465. I'm sure it is. It's 465-ish or 425, something like that. Anyway, if you want to try it, there's a link and a discount below. But what you get is £10,000 account, but your drawdown is 600. So you have a watermark of 9,400. The account cannot go below that. Once it goes below that, the account is bust. It blows the account. So really, when you're sizing, you are not sizing to 10,000. You should be sizing to 600 because that's the drawdown. So the drawdown goes, the account goes. Now, the targeting is then 10%. So 10% of 10,000 obviously is £1,000. But if you're thinking of your account as the drawdown, that means you've actually got to double it. And what happens is people oversize and try to get to that £1,000 too quick, because even though it looks like it's just a 10,000 and you're not using the leverage, you are, because the 10,000 is actually leveraged from the drawdown. Now, I'm going to go more into this about how to pass these challenges on Whiteboard Wednesday, and I do implore that you put your questions below, and I will answer them on Wednesday if I can. Now, that's the issue with the prop. Now, you've also got to adhere to whatever the rules are, and these rules do change from time to time. So you have daily drawdown limits. Some companies put size limits on. You can only trade outside of news events. All these different rules that are placed in to slow you down a little bit. So you've got to be a bit wary of that. So you haven't got full control. So your own account, 100% control. Everything you do is on you. With the prop, you've got to follow a set of rules, but you've also got to be really aware of drawdown and that you're not over leveraging, because you will blow out. Okay. Then you come into an investment. Now, something like Darwin X is an investment. They ain't putting money up. The money that you are trading, they do give you a sweetener in the sense of seed, and they'll give you seed money to keep you going. But their job is to attract outside investment from maybe you and I. Everybody can invest in this, and they look at the ticker the same as sort of just looking at the stock market and think, I'm going to put money in the S&P 500. You would look at a ticker that you like and you put your money in. Now, this can attract vast amounts of money, but you are paid a maintenance fee for looking after that fund rather than a profit split that you would with the prop industry. And the way it works is, I mean, on average, there's normally a maintenance fee of 2.5 and then a charge of 20% on a hedge fund. What Darwin X are doing is they have a flat 20% for the investor. They give 15% to the trader as the maintenance fee and keep 5% for themselves as an admin fee. So that's the way they do it. And the difference between them is there's not so many rules with the hedge fund apart from you have to perform. And if you're going to perform, you're better off being steady Eddie than king for a day. Little steps. 2 to 5% a month is deemed really good. And in the hedge fund world, that's probably about right. Put it into Google, have a look. It'll tell you that the average returns sort of 19 to 21% on hedge funds. And that's the difference between them. So really, you've got to see where you sit in this. If you've got your own funds, your live account is always the way. Always. You've got 100% autonomy over it. You make every decision, and nobody can interfere. The other side of it is, with your own funds, as long as you are with a fully regulated account, your money is also protected. So if you put £20,000 into it and you decide that, well, don't want to trade this anymore, you can take your £20,000 out. If the company goes bust, certainly in the UK where I live, you can go to the FSA and they'll get your money back. So, all right, you might have to fill a few forms in, but you get your money back. So that's the way to go. If you've got limited funds, you can buy into a prop fund and you can make your money work for you that way. The difference is if the company goes bust, you get nothing because it's not regulated at this moment in time. They've also got the ever-changing rules. You've got to be aware of them and keep up with what's going on. And the other side of it is you've also got to calm down when it comes to the leverage. In other words, always look at the drawdown. And I'll keep repeating that because the amount of people that blow their accounts is ludicrous. And it's because they don't understand the difference. And then if you just want steady growth, love the job, you can go down the investment hedge fund route is longer term. So they're the differences. And I hope that kind of clarifies things. But to sort of give an example of sort of monies that can be made or not made for that matter, I just want to show you something. Let me just flick this on because there was a comment saying they're doing 1% every day and they rarely have a red day. Okay. Well, if you've got 2,000 in an account, £2,000, because that's the average account size, and you did 1% per day for a 3-year track record. Now, this is assuming you have no losses, by the way, but you have, tell you what, we'll take out Saturday and Sunday. So you're only working 5 days and we'll give you a day grace for the days that you lose. So you're going to win 4 days out of the 5 or out of the 7 because you can't trade 7 days with Bitcoin, etc. now. But 1%, 3 years, 4 days a week, allowing for 1 loss. That would make you $1 million in a year, in 3 years. Are you a millionaire? Have you got that far off £2,000? Maybe not. But it kind of puts it into perspective. If you come into this industry with a realistic expectation, you'll probably be okay. If you come into this industry thinking you're going to turn your 2,000 into millions in a relatively short time, and that is under 5 years, you're probably delusional. And if you've done it, brilliant, more power to you. But that would put you in the top, probably 1% on the planet, if not higher than that. And hedge funds can't do it. I certainly can't do it. I know that. I certainly can't turn 2,000 into millions. I really can't. I'm good, but I'm not that good. But why am I better than somebody who sits next to me? What is my ultimate secret? Why am I a good day trader? It's because I know when to stop. I'll take 1 or 2 trades a day with perfect setups. And if I've got to wait for them all day and I only get 10, 15 pips out of it, I'm happy. And that's it. That is the only difference between me and you. I am patient. Most people are not. And I'm disciplined to wait. And it's a very simple process. I look at one asset for the day, whether it's cable, gold, whatever it is. I don't chop and change. I look at one asset for the day. I understand where its direction's going, or where I believe it's going. It's called the double D, dominant direction. And then I wait to get in on that bias. And then I get out at the next bus stop. It's that simple. Literally is. It's all marked up, and I'll get in at one level or one zone, and I'll get out at the next. And as soon as I've been paid, I walk. But I also have a management system put in place that I can build a position backwards to move forward, which reduces exposure, increases the upside. And again, that has set rules in it. 1, 2, 3 are the trade. 4 gets me out at break even. 5 gets me out at scratch. Now, break even and scratch are two different things, because you've got break even, which is the point of entry, and scratch is where you will sacrifice 2 trades in order to pay off the rest of the account. And that's why I break it up by 5. So I've always got 2 positive that can pay off 2 negative, and the one in the middle is scratch. That's it. That's the secret of trading. And as long as you keep it simple, you're fine. Cherish your thoughts. So as always, guys, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all in the next one.